I'm honestly sick of it and tired of hearing the narrative because we come from a world where it's apparently the news, the media is able to pin it down to one point. It's because of this, but it's not because of that. There are more people in the US living paycheck to paycheck today than going into those two recessions. Think about it.
Henrik Zeberg has been studying business cycles for decades. He predicted the COVID crash, the 2021 blow-off top, and the recent alt-season collapse. Now he's calling the next move, and it's not what anyone expects.
You'll see Ethereum actually be the one that is pulling it more than Bitcoin does this time, and that is normally the most explosive phase. I think we can have a massive run in crypto. People don't see that because if they did, everybody would already be.
Quick note before we continue. 85% of the people that are watching our episodes are not subscribed. But if you do enjoy the conversations with the smartest people in macro, finance and crypto, make sure to subscribe to this channel because it helps us a lot. Now, let's continue with the conversation. Henrik, welcome to the show, New Era Finance. In all the madness that we see in the markets right now, what do you make out of it?
Wow. I think we are there. What can I say? Many things which, or a lot of things where people would think that this is out of the ordinary way of, where things should be going. But I honestly don't think it's that, mad in the way that obviously we have with volatility, we have some fear now with crypto and so on and so forth. We have gold and silver shooting through the roof and all that. But it seems like things are developing in again, like as according to the business cycle that I follow or the way I look at things. So we are late cycle. We are in a way in a situation where people are starting to believe that we're not late cycle, and that could create a risk on environment. And we just come from an environment where we have been told that inflation would be here, it would be sticky, and you've got to invest into precious metals, and the world is collapsing when it comes to the whole monetary system. So I think it's more if you don't follow the narrative as closely, because I don't. I follow the business cycle, I follow data and so on, and if you do that, then it's at least I think I can find some order in it.
I think the whole target of today with the podcast is to make it as rational as possible, because as you mentioned, follow the narrative, but it also feels like follow the fear currently, which then leads into some certain market directions. But if we go down the list of all the things that have been happening in the markets and also what gold and silver have been doing over the past 4 to 5 months, what you hear right now is that by the fact that there is all the uncertainty in the Middle East, that gold and silver need to go up. But haven't the markets already been pricing in the actual event taking place, and the entire markets are actually going to rotate from that point?
Well, I think it has. I mean, I shorted silver yesterday into the open because I thought it was a good point. It seems like technically we have seen a top. I don't think people likes that, but that's the also normally the sentiment should be like that. So yes, is the answer to that. I think a lot of it has been priced in, you can say. But again, if you ask somebody 2 months ago why gold and silver was going up, they didn't talk about the narrative. They didn't talk about the Middle East. They were talking about how there was a de-dollarization. They were talking about the debasement and so on and so forth. All these things was on the topic there, right? And this is where the narrative keep chasing realities. And I'm honestly sick of it and tired of hearing the narrative because we come from a world where it's apparently the news, the media is able to pin it down to one point when it comes to why gold is going up. It's because of this. And it's, 9 out of 10 times there is some truth to it, but it's not because of that. So we come from a world where we, like human beings, we like the simple explanation. But there's nothing in finance that is simple. And when it comes to any asset, I've been working with models my whole life. I mean, there are hundreds of variables to any variable that you want to explain. So if you go to something and you say in the media, oh, this because of the Middle East, or it's because of that, because it fits kind of the way things are going. That's what people buying into, but it's never the truth. It's there's some to it, but it's already priced in, or it's because something else is going on. When it comes to gold and silver, normally when you have a business cycle ending, you have the inflation coming up at the end of it because the business cycle, the real economy is peaking out, and then you have inflation following that. And so when the business cycle peaks, you actually see inflation coming after. And when inflation goes up a little, this time it's not even up. I mean, we were at 9%. It's down to we were at 3% for some time, 2.7. Now we're 2.4. And people freak me talking about inflation. Going into 2008, you had inflation of about 5%. I mean, that's inflation. And we were talking about it around 2%. That just tells me again that there's all this chit chat because people can't understand it really well why things are coming out, and people are not really diving into the data and the details. So they say it's because of debasement and it's because de-dollarization. If you look to the amount of assets that is in dollars these days or denominated in dollars, it's not declining. I mean, it's just again chit chat. So what you heard 2 months ago, it was because of that. Now it's because of the Middle East. I mean, I don't follow that. And it's like, chasing, I don't know what, rabbits, down the rabbit hole all the time and just, keep it convincing yourself that that's the truth. The truth is the business cycle tops out, inflation goes up for a little while and then it comes down with vengeance and people all of a sudden, oh, there's no inflation. And the Fed has defeated inflation and then they turn on a dime. So I don't follow that the narrative there, and I every time people try to ask me the question, but why is it? And then I say because the business cycle, this and that. Then say yeah, that's great and fine, but why? Like if I have this one sentence news driven kind of explanation, and so I follow along when people ask me that.
There's a clip I saw last year. There was the trader on Wall Street being interviewed during 9/11, and he said, it doesn't matter why it happened because I can't trade differently. It's the what question. And then you need to react to the markets.
Right.
And the why always is going to be answered in hindsight, whatever fits your own bias.
Exactly. And that's my point. I mean, well said and well spoken. So I think it's the narrative chases whatever kind of development. And there is this simple one-liner that we can all, it's because war in the Middle East. That's why these things are happening. I mean, and very often you'll see that it's actually the reversal points of these things. So that's why I also shorted silver yesterday. Let's see how that works out.
How do you make sure to stay objective, neutral, and rational and prevent yourself from having a bias going into those charts?
Well, first of all, I base everything on my macro framework. So I don't start with a blank sheet every day, and I don't start with that silver will go in one direction and gold and dollar and stocks and so on. There is a nice structure to it. There's a pattern to it, and the pattern starts with one thing. It starts with where we are in the business cycle. And if we look to it, I mean, if you take a non-farm payrolls chart, you will see how it actually have a nice cyclical behavior, and you can start there. And then you can ask yourself, is that because things are just happening? In an ad hoc kind of way. I don't think it's like that. So when I start out with something, I don't go in and I just convince myself by one chart. Never ever. I ask myself every morning. I'll say, where are we in the business cycle? Do we see something that has changed? That is changing in my perspective on where we are in the leading, coincident, and the lacking indicators. No, we are still there. Obviously, it's not something that changes every day. It's like watching paint dry, but it's changing over time. And if you then start to look at, okay, so if that's the case, where are we then liquidity-wise in my liquidity layer? Okay, this is where we are. We have, positive liquidity inflow. It seems like it can support more risk on. Where are we inflation-wise? We are here. Okay, so you can start making yourself an understanding of these different scenarios you can be in, and then you can say, okay, these developments we see right now, are they triggered by some event which can happen for a little while, and then they come back to the equilibrium? Probably yes. And then you'll say, what is the most probable next step we're going to see? So I famously said for some time now that we're going to see this massive rally coming in risk stocks in the US. And I maintain that view. And I think we are, when we look at the charts and today, say, well, we have all the fear now there, but we still don't have a situation where the economy is rolling over to the degree where we should be expecting, bearish markets right here and now, even though we are getting closer. So I think you're going to have a fantastic rally over the next few months here.
I think one of the topics that I wanted to address, and there are so many, luckily, but when we look at the business cycle, you say that we are at the end stage of the business cycle, but maybe it needs some framework or some extra arguments there, because I don't know if you know the account TechDev on Twitter. He has a very beautiful framework when it comes to the business cycle. And he actually says that the business cycle is at its lowest point at this point and is going to pick up in momentum. And we recently had the PMI going up, going above 50. So I wanted to ask you, like, how do you define the business cycle? And why are you saying that we're getting towards the late stage of it?
Yes, if you look to the, I mean, this is great. And I love this. This is the what I call the liquidity versus the real business cycles, outlook. And if you look to it, you can ask yourself, why would the Fed and the rest of the banks around the world be lowering rates at this point if we are at the beginning of a new business cycle? Why is the non-farm payrolls, which is the actual number of people of jobs being created now, below the levels that it has been going into the last 15 recessions at this point and actually heading down? These things we can ask ourselves. Why is inflation coming down? It doesn't do that into a where we're starting, things are starting to pick up again. All of these things are telling us that we are seeing the business cycle is declining. And PMI numbers, that's at best coincident and maybe even a lagging indicator on the economy. If you look into recessions, you will see that the PMI number has been plummeting as the recession has already been going on for some time. Sometimes it is at a 50 or 48 or something like that when the recession hits, but it actually plummets before. But if you look to the real things out there, like for instance the non-farm payrolls, which is a fair thing, you can also look at the job cuts. You can look at the average amount of time that people are staying unemployed. It's all going up. That's going up. And if that's going up, there's nobody who can tell me that this is at the beginning of the business cycle. So this is fantastic. I mean, this is where people looking at PMI numbers, which is a business, it's a survey. You're going out, you're out talking to a person sitting in a business saying, how are you looking at things today? Are you, positive? Are you, sane, neutral, or are you bearish? And if you've been having a good day yesterday or the last week or the week before, then you'll say, it's an okay day. It's not very front looking. And that's why people looking to the PMI, I have to say, go check it out. Check it out and just put a very simple chart saying, where is the PMI level at? When do we have recessions? And what's happened there? And every time you'll see that the PMI number is not leading. It's at best in the middle of a recession or around the recession, but the plummet comes later. If you look to other things, like for instance, the momentum on the non-farm payroll, on the real economy, well, then you see something quite differently. You can also ask yourself the GDP number of 1.4% in Q4, apparently, as we saw. That's also not a good number.
And it's also the unemployment rate has been going up substantially, which is, I think it's the highest number in the past 4 years right now, like 4.6 or whatever. Actually, last month was quite good. But is there a gap between the stock markets and the real economy in those frameworks that is not being told to anyone trying to use those metrics?
Well, there always is. I mean, you can just look at it. Look at the Nikkei in 1989. Was that it peaked out in 1989? Was that a fantastic time to get into the stock market or to the Japanese economy? The answer is no. 2001, or 2000 actually, when the Nasdaq topped out at a peak, before it dropped 85%, was that a fantastic time for the economy? The answer is no. So why is it that we think that the stock market will tell us whether we are in a good place or in a bad place? It actually, if you look to the unemployment rate is what people always turn to, but you have to understand that the unemployment rate is influenced by one big thing, and that is the job participation rate. So if people are the labor market participation rate, which means that sometimes you'll actually see that people are saying, I don't want to be part of this no more. I'm just leaving. I'm not registered as part of the labor market any longer. If you do that, you're not being counted in as a part of the unemployment rate. So the unemployment rate is actually a very, very bad way of looking at things, because if people are getting demotivated to be part of the labor force, which a lot of people are when things are turning bad, you will actually see that can actually be a positive for the unemployment rate. So that's not a good way of looking at things. But what you can look at is the number of people, how long they stay unemployed. And that is a problem. Right now, they say that the average length of unemployment is 24 weeks. 24 weeks. In going into the 2009 recession, or into 2008 actually, it was we were at 16 weeks. So we are 50% above that. If you look to the consumer right now, you have the delinquencies on their credit cards and on everything else, and it's there the severe delinquencies are peaking up. So people telling me that this is a good situation and that the economy is recovering here, while you see this, because some PM9 number, because a manager of some business think, oh, I had a good day. It's fantastic. Let me say it's positive. That's not very leading. That's not very leading. That is actually, and that's where people look into PMI and to what the next problem argument will probably be is that the liquidity or that comes into the economy is pushing up. The central banks are there. Again, we can just look to that and say every time we see that, it's actually because the economy is turning down.
Before we continue with this episode, I would like to show you something really cool, which is that our partner OKX has announced the OKX card, which is a digital card which is fully into your account on OKX, where you can just use it for any buys that you do if it is connected to MasterCard. So it can be your groceries, it can be flight tickets, anything you want. And the cool fact is you can actually get up to 20% in cashback until the last day of this month. After that, you're going to get 4% in cashback. But everything you buy through the app this month, you will receive up to 20% in cashback. And then on top of that, you're also going to get up to 100 euros in Bitcoin. Find the link in the description below and sign up today. Now, let's get back to the episode. It's interesting because if we really start to look at the data, then for instance, the amount of properties that are currently on the markets to be sold and the ones that are being bought, the gap is the highest ever. When we look at financial lease for cars and all those things, it's also turning into the worst market since 2008. We've had the steepest high curve in 2022, but no impact on the real estate property prices at all. No impact on the mortgage or the equity markets.
Yes.
Yeah, that's what the point that I wanted to get to. Like, it's all there. There's so much risk in this system, but we kind of don't see to price it in yet.
Think of yourself. If you have a house and you can see that it's actually you find it difficult just to afford sitting and to stay there, you'll do your utmost not to sell it. You'll take 2 jobs. If you look at the amount of job people also have now in the US, it's also higher than it's ever been before. The people that have 2 or 3 jobs. So you do that because you want to make ends meet. Then you will only need to sell it if you really lose your job. So when the moment when you lose your job, you have a problem because then you can't afford it. And then you have the foreclosures and all that. But you will actually drag it as far as you can. So what you do is that you will max out your credit card. You will, stop paying on other things before you stop paying. You're doing on your house, but you're not going to sell your house in that period because you can't afford it to go somewhere else. So the reason why you're looking at those numbers you are there, I can tell you the number of homes sold, existing homes sold already is at levels we haven't seen, only into recessions, after recessions actually, where you have had unemployment going up a lot. The levels we have now is like, the levels we saw when the US economy was 80 million people smaller. And yet we have these numbers because people they're just staying put. They're just, okay, we got to sit it out. That is not a strong economy. When people cannot sell their homes because they can't afford to go to anywhere else, and they're just sitting there hoping that things will be fine, that is not an economy that's in recovery. There's no signs of recovery.
That's fair. That's fair. But then, on an ethical standpoint, how much of these data points can we actually rely on?
Yeah, well, I think when it comes to the non-farm payrolls and so on, I mean, first of all, they're not good numbers by themselves anyway. We know how they're being revised up and down all the time. We saw how the non-farm payrolls last year. We were starting out the year in Q1 saying, "Oh, things are great." We had a few months or 1 month at least where we have more than 200,000 jobs created. Apparently, now what they do after the year is over and done, they actually compare the balances and say, "Hey, how many people actually do we have now in the year?" So, and you can see that that number had to be revised by around 800,000 just a month ago or something. And that now shows us that we had a job creation of 181,000 throughout 25. 181,000. In the year before 24, we had a job creation of around 1.5 million jobs. So 181,000 for a whole year is terrible. So back to your question, how can we rely on it? I don't know if they are being masked or being fiddled with or whatever. I don't know. I'm naively trying to follow the numbers, and there can be some somebody who can claim that. But I can just look at the number that we actually got and say that from 1.5 million down to 180,000 for a whole year, that's terrible. And that we were told the whole year that job creation was around 110,000, 100,000. All of a sudden, we saw that for the whole year, it was only 181,000. So apparently, without having a tinfoil hat on here or anything, apparently we can't trust the numbers on a monthly basis. And that's what I said also when the 130,000 for the non-farm payrolls came out in January. I said, I don't trust that one bit, because the average level, the level for the whole of 2025 was 15,000 per month. You can't explain and tell me we all of a sudden went to 130 like that. So I don't trust those numbers. I don't trust the inflation numbers at all either, because we can see how lagging they are. And if you look to Truflation's great work, you can actually see that they follow it much more closely and they get, completely different picture for it. So we got what we got, but there is no doubt that the data points that we get on a monthly basis are not that trustworthy. And there is a big disconnect now between, I think you asked also that earlier, between what the markets believe are the truth and then what is the real economy. And I can just say, Titanic didn't sink with the first passengers getting into the water first. It sank so the third class passengers. And I think that is what people miss over and over again. It doesn't start with the first class passengers, it starts with the third class passengers.
I think to that standpoint, we had Michael Howell on the show a few weeks back, and he was explaining the difference between the stock markets and the real economy in terms of liquidity. And he says 2026 is going to be a year with liquidity not really going up, but the real economy is going to pick up some momentum at least because of all the things that the Fed tries to do, and the equity markets or the stock markets are going to see an impact from it. But on the other hand, we see people saying M2 supply is going to go through the roof, inflation is going to go down, the interest rates are going to go down with the Fed. What is your expectation on the liquidity and the influx of it?
Have the liquidity we have right now. I mean, I think we're going to have an effect from what we see in the real economy. Liquidity follows again also the real economy. I know liquidity can be supplied by the central banks, but it's not the same as it's going to have the effect into the economy, because in order to have the effect in the economy, you need to have Mrs. Johnson and Mrs. Jensen in Denmark and whatever it's in your country, that they actually start to, spend the money, and they want to, take on new credit and so on and so forth. Otherwise, it's idle money in the bank somewhere, and that doesn't give us a lot. So we need to see it rotate, and that is actually what the M2 gives us. But the M2 doesn't really tell us the direction of the stock market or anything like that. M2 is just a picture of one of the liquidity measures we can look at. There are many others. If I look at liquidity at this point, it seems like we have still quite accommodative liquidity regime, which is going to support higher levels in the stock market. And I expect higher levels in the stock market, but I expect the real economy to turn at some point here. I'm not seeing it yet. And I want to say that there is a difference between actually having hit the iceberg and seeing the Titanic actually going under. And the problem is right now, in terms of, problem, or the good thing right now, say, is that we're not seeing it to the degree where the real economy is sinking fast yet. But I think we are. It's only going to be a matter of when things are starting to push through to the businesses around in the US, and when they start to lay off people, then I think the repercussions of the that people can't afford their homes and so on and so forth, and the high debt levels and so on, can be actually a lever to that this can become more severe.
When it comes to the layoffs, I think there are two arguments, and I wanted to discuss these two, but we get to that in a little bit. I think Jensen is the most common name in Denmark.
It was at some point, I think so. Yes.
Well, it's funny, in my country it's Janssen, which is kind of the same as your country.
Yeah.
But I wanted to touch upon gold again, because the fact that we've seen such a big outlier with gold in terms of volatility is usually a sign that something is breaking. And we have also seen the Japanese rates go up, or the yields go up, which is probably not a systemic risk, but more of a unwind of a trade. Where do you put the entire run of gold in the bigger perspective? Because the gold bucks are saying, hey, it's going to go to 10K or whatsoever. I'm saying that we currently saw the peak already, and that there's likely a rotation of liquidity going to happen into other assets that have been setting off or haven't been following through. Mm-hmm. And the reason why I'm saying that is that I'm not charting gold versus the dollar. I'm charting gold versus the S&P, mm-hmm. or gold versus the Nasdaq. Mm-hmm. And that just broke out of a 15-year bear market.
Mm-hmm. Yeah, I think you're right in terms of that. That gold has topped here short term. I think that's right. I think the perspective's also on a longer time frame that there's something happening. I mean, I look at the other way. I look at the SPX versus gold, and if you look at that, there is actually a very nice line where you can see that we are breaking down below that, which means gold has now started to overperform S&P, and 500 has done that for some time. As always, we know that nothing moves in a straight line. So it's not like it just goes down and down and down every day and every month and every week. We don't see like that. We know that there is these bounces and so on. I think there's something seriously happening in terms of the whole situation with gold, and that we are getting to the point where gold and silver is going to have a fantastic time. And I did not see gold going to the levels they did now here, and I did not see silver going to this, because I think it was also an overshoot of where they were supposed to go, so to speak. But anyway, they went high. I think the gold bucks there are too early on it, because the unwinding of the monetary system, or the debasement of the dollar and all that is clearly not happening. And I think that they front running this, and they are coming up with that again narrative, and it kind of built on itself, and it was a self-reinforcing strength, and you could see that it just went up to, straight up on silver. I mean, silver is mainly an industrial product, so it was a talk of the town narrative, chit chat, and so on, and it just went up. Having said that, I think we have entered, excuse me, a new inflationary regime. But just like in 1981, when at least Volcker famously killed inflation, I think the Fed and the central banks and the administrations of the world, they actually gave birth to a new inflationary regime by 2020 in the COVID situation. Because when it comes to inflation, it's all about what is in our backbones. And our parents and grandparents, they would have known about inflation, and they would say, hey, inflation is there, it's 5, 6, 10%. I remember when it was 15 and so on, so forth. We have seen the opposite for such a long time, because of global trade, because of technology development, and so on and so forth. The thing is, now we have been reintroduced to inflation, and people are now starting to see that as something that can happen. And that is in the backbone. That changes the psychological behavior of people, of consumers, and of the whole chain of how we work as on a daily basis as well. So I think there is a shift. I think the new inflationary regime, and I have some charts showing that very, very vividly or clearly, there is a new inflationary regime in town. That does not mean that things will go straight up from here. It means that in a decade's time, we're going to be a completely different place when it comes to inflation, and we come to also yields, interest rates, and so on. But in the short time frame, and this is where people need to distinguish between long, medium, short. In the short time frame, we have a deflationary at least disinflationary move now, because of what we see in the economy. We see the non-farm payroll stalling. When it does that, we normally see that inflation is also starting to stall, which we have seen with the latest inflation when it comes to the CPI numbers. So I think the bulls and the gold bulls and the silver bulls, they were seeing this and thinking, oh, this is it. And now we just, hammer on. And to a certain degree, they're right. But I think they're going to be met by what is a normal pullback in that kind of in that move there. And that means, as you said exactly, I still think there's going to be a rotation because, as you also said earlier, but we got great PMI numbers. The economy is starting to pick up. There are certain economists who think that we're now reaccelerating the economy. I mean, I'm old enough to remember when we said that in 2001 and 2007 and 8 as well. And we saw that we had then the deacceleration when we had deflationary developments. And I think that is going to come again. The Fed is terrible late. There's no pressure on inflation at this point. And that's why gold and silver bulls are going to meet somewhat of a headwind here. But again, they did well. I would just think that they should, consider whether things are just going to go straight up or it can take a rather strong decline into a final scenario where you have a risk on for a little while because the guys like you talked about before, they're saying, oh, but the PMI number is up, hence we have a strong economy and it's reaccelerating. If the economy is reaccelerating, you don't want to buy gold and silver. You want to buy tech stocks. You want to buy, whatever has been beat down, everything that can grow or, have growth stocks, right? And that's what the phase I think we're getting into until the next narrative comes around, which is, oh, inflation is actually very bad. And there is a full stop because recession is going to hit.
I think you're completely right when it comes to this fact that also like gold is becoming a very crowded trade, and it's not the best to stay in a crowded trade because usually the people are wrong. Then on top of that, I think a lot of asset managers are doing their investments based on a lot of metrics, like for instance, Sharpe ratios. And I'm sure the Sharpe ratio on gold is going to go down massively with the current potential downside that there could be in. And then on the other hand, we have equities in Bitcoin and crypto that might get a better Sharpe ratio from here, or at least a better investment thesis. So that is independent of what thesis gold has. It's just going to be reality that it's going to go down because volatility up will also be volatility down. But I wanted to grasp your idea of like, we are late cycle. And I agree with that, but I find it hard to see which type of cycle end stage we are in. Like if we see the breakout of gold, we could say it's like 2006. It could be 1999 or like 1928, because all those metrics that we are looking at for potential financial crisis and stuff are all giving us red flags.
Yeah, but I'm not sure that it necessarily gives us a red flag. I mean, if you look to gold into 2008, or is it remembering when it was actually into the top we had in March of 2008. You can actually see how gold was up. I think from if you just take it a few years before that, if you go to actually looking at the chart here, it actually had a massive rally also from 2005. And until the top, it was up, 200-300% from 2003, I think, something like that. So it had a good run there as well. And that is what happens into that late phase. So we cannot just look at gold and say gold is something we run to when we need to run for the hills. That's what we like to say. But then if that's the case, why did gold decline in from March of 2008 until October 2008? If there was a time where you wanted to run for the hills, that was in that time frame. That was in the time where there was an illiquid move. Silver went down 60% from March 2008 to October 2008. So people are getting this about, we need to run to precious metals when things are getting bad. It's not entirely the truth. What people miss there, as I think I've been trying to analyze the psychology behind that. Why is it that people say that? If you have a normal deflationary development in the economies during a recession, you see gold and silver decline. What people are referring to potentially is that they know what the Fed is going to do. And when they do that and they come in and they supply enough liquidity, then gold and silver takes off. So gold and silver took off in 2008 in October and until 2011 or 12 or something like that. And then they had a decline again. But it's wrong to say that gold and silver are the run to when you have a deflationary development. So if you have a stock market that is overvalued and you have a bust that could become, or a recession that should be setting in, you don't want to run to gold and silver. because what you want to run to is the liquidity which is needed to make sure that you can do your payments on your loans or whatever it is, or close down your loan or whatever is needed. That is why the dollar actually rose quite strongly in that period. So people are confusing themselves. They got this into this is called a dogma. I mean, there was in the 1990s, there was the Danish film producers. They were jumping into a new world of new dogma of how to do films and to work on films. And they actually started to go with handheld cameras and so on. That's something you do today. But it's something, why did we do that before? It's the same thing when it comes to the whole thing about gold. Oh, if there's going to be bad times, then I have to buy gold. But just listen to it. If you look back to it in time and say, no, in bad times, you don't buy gold. You use your gold to sell it to make sure you get the liquidity you can have to make sure you can meet your obligations. And this is what I think people are getting wrong sometimes. They just jump to that conclusion because it's so much into their backbone of how you need to think. So yes, to the situation, if you going to have a stagflationary development like what we had in the 70s, different kind of setup. But that's one type of crisis. That is like the 9 months we had after COVID. We had 9 months there where bond and stocks went down. Gold was a good place to be. But it's not a good place to be if you are in a situation where there is a deflationary development and things are starting to implode. That is where gold does bad. So people have it like, is it a crisis? We need to buy gold. No, that's incorrect. You need it for liquidity, but then you will need gold when the Fed comes back in again. That's the distinguishment that you need to distinguish. Or if you have a stagflationary development, then you need gold and silver but you need commodities then. And that's for later. So I think people will need to distinguish this correctly here before they jump to that conclusion.
On that, I think there's also the sentence that says that a crisis doesn't start when everybody thinks that a crisis starts. And that's quite usual that what we see on social media, at least the hours that I spend on X, for instance. If I look forward, then it seems quite obvious that we're going to get into a stage where all of a sudden the PMI data becomes better, gold is going to go down, Bitcoin and crypto go up, the stock markets are going to break out to the upside, and everybody goes back to their normal life, thinking that there is nothing happening.
Right.
Which then brings me back to a book that I've been reading about the 1920s. That we have one big takeoff in 1929, and then all of a sudden everything crashed.
Yeah. And I think you have the same actually in 2007 if you look to it. If you look to August of 2007, from the bottom in August 2007, when we started to hear of the subprime, and you actually saw a 25% move from August and until October, where you had the top in the stock market. 25%. Why would we have 25% in an economy that was heading right into a recession? The recession was baked in at that point. Subprime was exploding already beneath the hood. Nobody could really see it yet, but we thought it was all contained. It was a 25% move from August, and this was in the Nasdaq, by the way, but 25% in 11 weeks. Why would you have that into it? Because some things don't end when it feels, it ends when it feels the best. I mean, and one of these things is in the economy. So people are, jumping onto this conclusion. Now things are great. Things are great. And we got PMI numbers. They are looking fantastic. The Fed is telling us that they are behind things. Inflation is down. What's not to like? What's not to like? And that's where they get confused about how the real economy works, because the real economy is about Mrs. Jensen or Jansen or Mrs. Johnson in the US, right? It's about that person. The 70% of the economy in the US is driven by consumers. And 50% of that is driven by the 90% of the consumers. So if you take that out and you look at how badly they are, how bad they are these days, compared to into 2007 and 2008 and into actually 1929 also, there are more people in the US living paycheck to paycheck today than going into those two recessions. Think about it. So people are confused about what they need to look at. It's like driving your car and you want to look how fast you're going, and then you look at how much, on the gauge of how much fuel you got on. This is how it looks sometimes, honestly. And if you look then to as I said, the non-farm payrolls, this is the
Hmm.
amount of jobs created in the U.S. It's so simple. Look at look at the momentum of that. I don't understand why we have to do that. We've done it the last 20 times. We've seen it when it starts to decline like it does. It doesn't just magically turn up again. And even though the PMI numbers is something that is normally out of touch with where we are in the economy. So I don't know. It's a gauge choice, I think, and I think it's about looking at the consumer, the labor market, and also the short-term yields because the bond market is a major gauge also on what is happening in the real economy.
Before we continue, this is the chart of Ethereum. And if you were holding and investing into Ethereum over the past 4 years, you would have had no return. And that's why I've built MN Fund, which is a AFM registered fund in the Netherlands that is profiting from volatility. Whether the markets are going up, down, or sideways, it doesn't matter. As long as it's volatile, we generate a return. And that's why in the past 8 months, we have been able to do it better than Bitcoin by more than 40%. And this product is designed for someone that is looking to invest into the crypto markets, but doesn't understand the complexity of the markets as a whole, but sees the opportunity of the entire asset class. And that's why we've built this entire fund with 3 baskets, which is we invest into protocols that are fundamentally strong, we trade the volatility with the automatic trading systems that we have, and we do OTC trades with foundations to support those foundations. And that's an interesting setup for anyone interested to invest into these markets. If you're interested into the fund, make sure to go to our website or reach out to me on LinkedIn or on Twitter. I'm happy to chat to you and assist you with any questions that you have. If you're just like a retail investor listening to all the information and all the noise that's happening right now, we are currently at this stage. I find it interesting to understand why people are going to be jumping into those risky assets when things are looking to be normal and just forget to realize that there is something broken, which feels so standard to me that I want to go risk off and they all want to go risk on. And then at the end of the day, you will see a big crisis taking place. They start to become angry at governments, etc., etc. How can you protect yourself against all of that?
Yeah, but that's always again we would like to put it down to one thing, right? I mean, it's like with the explanation before. We would like to say, so buy this and you'll be safe, right? That's what we would like to do because if the world is simple, it's easy to grasp, and we are. I mean, human beings, we are a little lazy. I mean, that's the honest truth. So we would like to hear what can I buy so I can be safe. Well, the problem is if the regimes can shift like this, then you cannot say one thing and you'll be safe. What you buy in the one scenario, you'll be very unsafe in the next scenario. And you can say, I mean, like look into COVID, for instance. Going into COVID, before there was a reaction like none of you ever seen. I mean, the most expansionary, monetary policies and fiscal policies that we have ever seen. Before that happened, would it good to be in Bitcoin, for instance? No, it would not. It was not. In 3-4 weeks, it went down by 60%. Was it good to be in Bitcoin the moment after when this surplus liquidity came in? Yes, it was. It was actually when it actually was shooting up like nothing else. So it's about the understanding of which regime are we in. That's why I'm saying when I use my macro framework, it's about understanding the regime we're in, not understanding the charts, understanding the regime. And right now, I think you're right that we are going into a risk-on regime, and people will be wrong, but they will also be right. They'll be right because they will be right for a certain amount of time that things are going higher. And they'll tell you, Michael, Henrik, you're wrong. Why are you so bearish? You should just be bullish here. I am actually very bullish. But the thing is, they will be right and right into the top. And they will be shouting the loudest the moment we hit the top. So I think I can't explain you why that is. I mean, people are maybe not looking hard enough. I think that's one thing that is probably the explanation. But also, it feels much better to stand with the crowd. It feels so much better. I mean, nobody likes to stand out, and it's probably from living in the savannah or something like in Africa back in the days as gatherers and hunters. I mean, if you're standing there in a group of 20 and the lion comes out, or it's probably better to be with the 20 others or 19 others. But if you're stood alone, you're gonna get killed. So this about being alone with a perspective feels wrong, and it feels so good to be standing with a crowd. So I think that's why mostly people will be wrong. And I actually gauge my views very much on: am I standing with the crowd right now? Then I'm painfully aware that I'm standing with the crowd. And if I
Mm.
don't stand with the crowd, then I'm painfully aware that I don't stand with the crowd. But I can also feel that because people are punching my nose all the time with why I'm wrong on this perspective. So I think it's about understanding that psychological behavior in human beings, that we like to be part of the crowd. It feels good. And if we have 5 good trading days behind us and we stand with the crowd, everybody who says something opposite will be wrong. And that's why
Mm.
the stock market feels so good until the moment it tops out. What can we buy into that? I mean, right now, I would say risk on US markets is a fantastic place. I mean, as you've seen the whole world going vertical here and on the indices, you look at the Canadian index, you look at the Kospi, you look at the Nikkei, you look at everything around the world has been going vertical for the last few months here. And the Nasdaq has been consolidating since October together with Bitcoin and not make a new high. And people saying, it's topped. Forget about it. The U.S. is decline or whatever as they talk about. Wrong conclusion. I think what is happening is that you see it consolidating before it starts to go much higher. But that will then potentially be those 11, 12, 14 weeks that we saw in 2007 as well, because you're also right that there's something broken. But what you need to be in the next 10 to 15 weeks can be one thing, but what you need to be after that, in terms of long or short, can be something different when you come to the end of that. So I think it's very difficult. I'll be long risk at this point, very long risk. I am. I am exposed to a blow off top, a sugar high that I call it, in U.S. equities and crypto stocks. And then coming into that top, I will be taking my chips off the table, and I'll probably be mostly liquid for some time before I will start piling into commodity companies down the road.
Well, Bitcoin hasn't really been consolidating. I would rather say has been going off a cliff.
Mhm.
But to your note, when it comes to a crowded trade, I was at the gold event 4 weeks ago,
Mhm.
and well, everybody knows that I'm full into crypto. So I walked into that room, and within the first 15 minutes, people started laughing at me for being in Bitcoin, and then I was like, I hate this so much, but it tells me even more that I need to buy more Bitcoin. So I just walked out and just went away.
Yeah.
But to the fact that you're saying the coming 15 weeks, why is it so tight? Why are you saying it's going to happen within such a short window?
I'm not saying it will necessarily. I'm saying that
It's a scenario. Just like,
it's for me. I'm people saying when. It's not it's never the when. It's about where and what we see. So when people talking to me about when, I try to tend to say I rather talk about what I need to see and where we are. And if we reach 7,800 on the S&P and we reach 30,000 on the Nasdaq and we reach 120,000 on the Bitcoin, then I would look at the individual weekly candles, daily candles, and all other things we start to see, reversal candles, reversal signs, and then say, are we at a top at this point? But that can be very fast. And what I'm saying is that we, base-wise, regime-wise, we are in a similar regime to what we were in 2007. This time, we don't have a subprime in the mortgage and with mortgage loans and the likes. We have a private credit situation, which people are not really paying attention to. We have a lot. I mean, we had a hunt for yields for years and years because when the safe rates, the government bond yields are low, you want to find good yield somewhere. You're going to find a good return. And if we do that, you can't find it. You send your money, you can't find it in the stock market because, everybody's there. You want to go to some private equity funds, to whatever, and you start pouring your money in there and say, hey, go find good deals. You're a partner in a private equity company. And when you do that, they will go out and they will do more and more risky investments. And that's the situation. So we also have now a lot of private credit that has been finding its way into the consumers layers again, outside of the banks, which means we cannot see this exposure on the bank balance sheets as we could in 2007. It's a very, very opaque structure right now in terms of how credit is now being, but the structure, the size of private credit now is probably around 2 trillion. And if we start to see some fall downs of there, then we can have a lot of problems. I'm not saying that is going to be the cause of the crisis. That's going to be the amplifier of the crisis. And the cause is going to be Mrs. Johnson, Jensen, or Jensen that will not be able to pay their bills because not only is she now, in a house she can't afford, but she's also losing her job. And if that situation starts to unfold, which I think we're getting closer to, whether it's going to be AI driving it or whether it's going to be lack of demand, you're going to see that. That will create a situation where the other elements, which the private credit situation can start to bring to the table that they can unfold. So I think we are in a situation that can unfold over the next 10, 15 weeks. Could it happen until end of year? Also possible. But I wouldn't be asked saying, when. I would rather say, what is it that we need to see? And I'll be paying attention to the short-term yields. If they start to collapse, then I would be. Then I think we are getting closer.
I think you touched upon AI in that sense, and AI is by definition the biggest, influence or change in the markets currently. I think recently Jack Dorsey has been publishing his tweet on laying off 4,000 people just because AI is going to basically take their roles. I saw an interview with Brian Armstrong, the founder of Coinbase, or the CEO, that 50% of the customer relations are being done, or customer service is being done by AI. So it can be confusing if we look at that perspective and more companies are going to integrate AI and lay off people, that by having more layoffs and a higher unemployment rate doesn't necessarily mean that there is going to be a lower GDP.
Remember, who creates GDP? Write up the formula for GDP. The formula for GDP is GDP equals private consumption plus private investment plus government spend plus net exports. And let's just focus on the sizes of those. Private consumption is 69 to 70%. I mean, I haven't heard of any AI bot or anything that pays tax or, by the way, goes down and buy a new car. So if the people saying that, but AI is going to solve that, no, listen. AI is going to be a supply and demand. I mean, it's back to the COVID example. Supply in the businesses are going to be increased. The capacity is going to be increased. The capacity utilization of businesses right now is around 76%. Normally, they start to lay off people when it's around 79 to 80%. Why would they hire more people in the current situation? They would not. That means that what is going to get hit is the consumption element, which is the 69 to 70%. Then people say, yeah, but you can add up with investment in private investments. It's normally only 70 to 20% of the GDP, and it doesn't consume. So you can do that for a certain amount of time, but if consumption and demand doesn't push up, there's not the need for it. So you can invent the shit out of things, and you can get the capacity load like nothing we have ever seen out of things, but it's not going to solve the situation that you can have a GDP that can actually decline in that situation, and actually probably most likely will. It's like when shifting gear. I mean, AI is going to be the most fantastic things productivity-wise that we have seen ever, probably. I mean, again, it's difficult to compare to when the steam engine came out in the 1840s, and because that was a massive thing as well. Well, I mean that. Honestly, people think, and also
that's true, yeah.
And also electricity in the early 1900s, right? It's a fantastic thing. Also, AI, amazing, great, huge, but it's increasing capacity in a situation where the consumers, which is demand, are already up to their neck in debt, first of all. Secondly, are being forced out of labor because of AI. And then we are thinking GDP is going to pick up. People who says that don't understand economics. This is actually the one thing we learned, first at the economics studies and back in the University of Copenhagen. This simple equation is going to help you so much if you want to understand economics. You cannot invent yourself out of it in a short time frame. You can do that in a long time frame, but that requires a long, transformation where the people that we have right now starts to consume. First of all, again, that's one thing. We need consumption to go back up. Secondly, you need that whole transformation of the businesses to go on. And the productivity lift that we're going to see is then going to create something positive back in. So in 5, 10, 15, 20 years, massive, massive development. But the next 5 years, 2 years, 3 years, it's actually counter productive or counterproductive, but it's going against the growth in GDP. Can you follow my lead?
Yeah, completely. I wanted to ask that question because I'm trying to understand what Trump is doing with his economic policy, and we have a huge debt ceiling at this point, or a huge amount of debt in the US. And there are two ways of attacking that. There is one, just taking the debt in and just letting everything crash and just get back to fair markets, etc. Or the other way around, and that is inflate yourself out of the debt through increasing the GDP. So basically, year on year, you get a less amount of debt versus the amount of GDP that you have. But now you're actually saying that it's going to be the inverse. So I'm trying to understand what Trump is trying to achieve within his 4 years of being in the Oval Office.
I mean, not about Trump or any US administration, but it's not always the politicians. They have the whole picture. Let's just be, clear of that. And it's not like the Fed has any kind of magical, approach to the economy because they didn't see inflation going up to 9.1% after COVID, after stimulating into a supply crisis. They didn't see the financial crisis, even when we were in the midst of it. They were still thinking that we could avoid a recession in February of 2008, when the recession was already ongoing. So I don't think that there is any clever man, Trump or anybody else, who is able to see right through this whole system here. I think people are putting too much faith into the Fed, into politicians, into Trump, into anybody. This is not a political statement. This is just a general perspective. The understanding that if you have an economy that is going to grow, you can grow it tomorrow by letting the Fed, by letting the government actually, starting to buy more, and the U.S. has actually done that. But they are also cutting back on that now. That is actually pushing GDP down. You can say it's a good thing because then you open up for more private initiatives, also good. But in the short time frame, you will see that there will be a push down, a negative effect on the GDP from AI implementation. It cannot be any way else in the short time frame.
I agree on that. When we talk about the final stage of the bubble or the final stage of a cycle, in the last 10% of a market cycle, 90% of the return is made. Usually, that's what we saw with gold and silver in those final few weeks. They were up the most.
Yeah.
But when we talk about that perspective and that we're going to get into a phase where very likely, in your words, equities are going to pick up momentum and it's going to be more risk on, then I would say that crypto is going to benefit the most out of it because they are the highest beta play when it is on risk on appetite. How do you see that going forward?
You're preaching to the choir. That's why I'm loaded up with that. No, so ETH treasury companies right now. I mean, people are so negative on crypto at this point. It has run its core. I think down the road there's going to be a completely different perspective on on Bitcoin and on everything else. Right now, we're not at that shift yet. People think we are at that shift, and where we may have seen the top in let's say Ethereum at least. I'm not sure about Bitcoin actually. I have to say that my scenario is actually Bitcoin potentially has topped out, but I think people are underestimating. I mean, if Nasdaq hasn't topped, the chances that if we go into a 25% move in the Nasdaq higher, which I think we will, that Bitcoin is not going to pay attention to that, and Ethereum is not going to, and the whole. And if you look to a simple thing like the Bitcoin dominance, which seems like it's rolling over, and then see people say, yeah, it's going to stable coins. No, actually not, because if you look into what is called the others index versus Bitcoin, you can see that is very, very bullish. So it doesn't look like that. It actually looks like we are in a coiling up crypto market that is waiting to explode. And that's why I'm saying, yes, there's going to be a risk on phase where you, as you put it also, you're going to see crypto and everything else is going to do absolutely amazing and fantastic. I think we can have a massive run in crypto. People don't see that because if they did, everybody would already be in the trade. We need to get everybody out of that. And then it can start. And then people will be piling in. And when we get right to the top, everybody will tell me how crazy I am because I said it's time to get out. So I think it's okay and fine. If you get a risk on environment, this is again back to invest into scenarios, into regimes. And the regime we're going to move into now is going to be a risk on regime for a certain amount of time, whether it's going to be 2 months, 3 months, 6 months. I don't care. I want to be ready for
Hmm.
that regime. And then I want to be ready for when we get to the top. So yes, to your question, I see crypto, Bitcoin, and especially there'll be certain altcoins that'll do extremely well, and then you'll see Ethereum actually be the one that is pulling it more than Bitcoin does this time, and that is normally the most explosive phase. That is when Ethereum outperforms Bitcoin.
I think since last year, April, Ethereum has been outperforming Bitcoin already.
Correct.
It's just not being discussed yet. But
Correct.
with the Genius Act coming into play later this year and the Clarity Act being approved, it will have a positive impact.
Yes.
What type of advice would you give to someone listening to this show going into the volatility of the next few years? When volatility goes up, what should people do?
What I tell my children also is that don't listen to what everybody else is saying, because if you just have to listen to what everybody else is saying, then you don't need to think. So I want you to think. And if you are in the same place, as I said before, with everybody else, and you feel good because everybody's patting your back, then probably you should start to worry. So I would think, and then I would say that, well, there's no wise people out there. There's nobody who can ensure that things will go fine, and there's no safe haven in any asset around the world for a long time being. There will be something that will be good for a certain amount of time, depending on the different regimes. And that is what we need to answer. So understand the regimes, but first of all, think. And if you don't understand the argument that somebody is making, then probably it's not necessarily correct.
What are some like books that you have been reading or are recently reading that are shifting your mindset?
Yeah, no, there's a lot of things that is actually I try not to read too much, economics and finance, and I need more, just good stories, and I like to read about history. So that's it. I like to study the markets more in the way that I study patterns, I study the regimes, and so on. So and there's nobody with the field of work that I'm doing in terms of business cycle. Nobody has written that book. I mean, I'm in an exploratory phase in terms of developing my model and my framework, and so
Hmm.
but I study obviously Howell, you mentioned before. He's been writing some good stuff, and I study some of his work obviously, and others who've been also writing about liquidity, because understanding the whole liquidity cycle in my model is important. I wrote a book myself also to try to explain that we need to understand that the central banks are not the geniuses that we think. But obviously also there are some list of books that I've studied also. So I think it's about people saying read a book, and you should read books every day, but you should also study. And I think the way you study is that you dare to take a theory and put it on the table, and then you start to put some empirical studies back to it. And that part is actually where you can actually lift your own awareness of things instead of just being told how the world is looking.
On the history aspect, Ray Dalio has been trying to connect the dots when it comes to regimes and in terms of cycles.
Yeah.
And he recently made that post with the chapter of changing world order when it comes to the final stage of this world order, which we call United States. What do you make out of that? Are you reading his stuff too on this?
I haven't read that explicitly, but not yet, and but I will look into it. Yeah, but I mean, The Fourth Turning also is another book where I
Hmm.
mean which I enjoyed reading, and I think there is in this bigger schemes of things, the bigger cycles. We are human beings, and our the way we act and so on will be dependent on our our psychic or the psychology of the humankind, and that's why we'll keep doing some of the same mistakes over and over. And what we're seeing now is some of the things that was in that regime shift. That's a very big regime shift, and I would guess that that's also what Ray Dalio is talking about as well. But yeah, the bigger shift in the economy and in the political environment, which is probably what he meant by what you said there, is something that is happening, and we know that, and we can see that from the geopolitical situation that the Pax Americana world that we've been living in is now changing, and the whole monetary system is changing, and so on. So there's a lot of shifts, and getting an understanding of that is absolutely important. So yeah, I would like to see what I haven't studied that or read that book yet.
Well, it's a very thick book and it's a very long read. I've been going through it and it takes a few weeks, I can say. But yeah, we just had Lynn Alden on the show and she has been talking about the fourth turning as well. Henrik, thank you very much for joining us. For people that are not familiar with you, where can they find you with all the content that you create?
Yeah, so first of all, you could go to X to at Henrik Zeberg on X. I also have at Henrik Zeberg on Substack, where I also write some articles with the perspectives that I laid forward here today as well, and also with Swissblock, where we have some services where we assist institutional clients in understanding the macro way. So, but all of that you can also find the links, through my X profile or my Substack profile.
And all the links will be in the description beneath. So once again, thank you very much for joining us on this show. I'm looking forward to having you on again in a year to discuss whether or not we have been seeing the big blow off or where we stand with the markets.
Sounds good. Thank you very much.